Now let's talk China. The country's industrial output gained momentum last month. For more on what seems to be a stabilization in the world's second largest economy, we're joined by London School of Economics professor Keyu. Keyu, great to have you on the program because actually we've had so much news on China. We had, the MSCI saying it was about to include China, but not straight away because they're waiting for more regulatory transparency. We had the overshooting of a lot of, the stock market, and then we have this news on some of the output. Overall, are you confident that China is on the right path?
Absolutely. I think financial reform is the key policy agenda for the government, and that's what they're focusing on. Interestingly enough, this move towards MSCI can act as kind of an external commitment device, which China loves to adopt to not only push and accelerate the capital market liberalization reforms, also financial regulation, adopt international best practices. China joining the WTO, joining the World Bank, fixing the exchange rate, all act kind of as an external requirement to push through certain, key criterion. So I think the move is certainly positive for the Chinese government's point of view.
Okay, you think a lot of these reforms will actually be delivered sooner than we think in terms of the timeline? And we've always known that, this is a huge adjustment period for China,
right.
But we always think it's 3, 4, 5 years down the line. You think this may come much quicker?
I think actually for the Chinese, it's been way delayed. So it's more relative to the Western view that a lot of resistance to reforms that it's being accelerated, but it's actually kind of on track, and if anything, it's going to be delayed. But I think it could happen faster than what the Western market is expecting.
And what's the key reform that you're looking for? I mean, again, we start to have hints of this. Also, maybe some of the companies going bankrupt, and we've always thought that maybe a way of the government letting off steam, and at the same time warning some of their own companies.
Right. No, I think a lot of these financial reforms are going hand in hand. So capital market liberalization has to go simultaneously with exchange rate liberalization. I don't think there's one reform that precedes the others, but they're taking slightly baby steps. For instance, setting up the Shanghai zone, and now opening, including getting to the MSCI. That requires a lot more openness between Hong Kong and Shanghai. That's a baby step, but I think it will happen simultaneously. And I think the most unexpected is going to be the exchange rate liberalization that will happen, I believe, within a year to 2 years time frame.
And so what does that mean actually for also our view of China?
I think the government is much more better able to handle volatility. And in the past, they tried to suppress all kind of business cycles. So you see kind of a smoothed out version of any other market-oriented economy. And they're less concerned about that. They're more confident about the banking system able to handle the volatility. And so opening up the A-shares to international investment also means the potential for quite volatile short-term capital flows, also with exchange rates. So we're seeing a government that's more confident and more tolerant for business cycles, and they're not going to try to go intervene and suppress it every time it goes up or goes down.
Keyu, it's difficult to say that actually China, in certain aspects, such as the market, such as real estate, is not in a bubble. But should we be concerned that the bubble is about to burst, or can this bubble last 5 to 10 years?
Well, one thing is clear, is that it's not going to be the government that's going to interfere with the stock market, for instance, to suppress a rising bubble or try to, kind of build up the stock market. If anything, it would be a loss of consumer confidence in the stock market that might lead to a drop. I personally believe that there's still a lot of pent-up demand for housing because urbanization is only halfway done. And it's true that investment opportunities are still very limited in China. So it's either investing in housing or the equity markets. Plus, also there's speculative motive behind this. But there's a new generation of investors, my generation, who are just coming into this market. They're not quite wealthy enough to invest in housing or property, so they put their savings into the stock market. So there's a new demand for assets. But they have not quite lived through the pains of some of the past investors, so they're still wildly optimistic. And an interesting terminology is that you don't invest in the stock market, you play the market. That's the common terminology. So there's a reason to be concerned, but I think over the long trend, there is room for optimism for both housing and equity markets.
Okay, do you think we need a correction sooner rather than later to almost ward off, as you say, if this is one of the only things maybe that people of a certain generation with a little bit of income but not super rich are investing in, there's danger that actually this will just go on until it's no longer tenable.
Yeah, I think that is definitely the main sentiment for the Chinese government as well, that it has to be cooled off slightly, but they're not going to necessarily actively interfere, which is different from in the past.
Keyu, the other thing, so we've heard since really the beginning of the year when the Prime Minister of China was in Davos saying, look, guys, you have to make sure that you understand we're going to grow a little bit less than we have in the past, and you just have to get used to it. Right. Is now this understood by people, worldwide, or are we still putting too much hope on China?
Well, I think we have to live with the fact that there's a short-term transition. I mean, think about the fact that transition not only towards more away from investment to consumption, but also towards expanding services. This is where the jobs are being created. 80% of employment is usually created by the services in any other country. It's only 35% in China right now. So it's a jobless growth miracle. So the short-term transition is going to unleash a lot of efficiency gains in the long run, including employment opportunities, boost up the consumption capability. So it's a short-term effect that we have to be able to reconcile with, but that does not mean that there's no room for growth, because we have lots of misallocation of resources, especially in the capital markets, and that comes back to the financial reform. If that goes through, then that's going to unleash a new wave of growth potential.
Yeah, it certainly will. Keyu, thank you so much for joining us today.
Keyu Jin
there, professor at the London School of Economics.